Welcome to another episode of the Federal Church Presents Better Than Bloomberg, covering the 2023 global financial system collapse, the worst ever. And another note from Zero, or actually from the Epoch Times there. And it's about the Fed, or I guess the Treasury too, going all in on making you poor. At least for the 99.99%. So Yellen warns the next crisis could come from shadow banks and regulators must act. This is from the we'll never see another crisis in our lifetimes lady. Treasury Secretary Janet Yellen on Thursday said banking rules may need to be tightened after the recent failures of Silicon Valley Bank and Signature Bank. It's not banking rules, dipshit management that should be fired. Kept doing the dipshit trade, and it wasn't any regulators' fault that they imploded their banks. While warning of structural vulnerabilities, the entire banking system is insolvent, that must be addressed in the shadow bank sector that includes things like hedge funds and money market funds. Looks like they're just starting to figure out how money market funds work and who runs them. In remarks prepared as the Reverend has been prophesizing, because again, this is brought to you from the Jesus. I am just but a vessel of God. This is like the divine right of kings here, but this is just the divine right of the Reverend to your tithes. So make sure to donate in the Bitcoin wallet there in the description. So in remarks prepared for delivery to the National Association for Business Economics, Yellen said that banking regulation and supervisory rules need to be re-examined in the wake of the twin collapses of SVB and Signature, which were sparked by bank runs. They were sparked by bank runs because they were insolvent, because their management was incompetent, and they did the dipshit trade. So I guess now you have to babysit management too. Supervisory rule. Anytime a bank fails, it is cause for serious concern. Regulatory requirements have been loosened in recent years. I believe it's appropriate to assess the impact of these regulatory decisions and take any necessary actions in response, Yellen said. Yellen set a 2018 rollback of bank capital requirements and stronger supervision for smaller and mid-sized banks with assets below $250 billion should be reevaluated. Again, this is ridiculous because they were just too stupid to run a simple depository institution. The capital requirements are that you keep capital there. You should have figured out that the U.S. Treasuries were going to be worthless because you're in an inflationary, hyperinflationary environment, after printing trillions of dollars. So again, babysitting these idiots who shouldn't have their jobs likely, will not fix anything because they're still idiots. She added that regulatory reforms put in place after the 2008 financial crisis have helped the U.S. financial system cope with shocks, but that gaps remain in their scope to bolster resiliency. But the failures of two regional banks this month demonstrate that our business is unfinished, Yellen said, adding that the U.S. financial system is now considerably more robust to shocks than it was during the previous crisis a dozen or so years ago. This is perhaps best illustrated by the fact that we've seen relative stability in the overall banking sector this month. What hasn't? They're still insolvent, and they get more insolvent by the day. They just printed a ton of money, and they promised to print tons more money, which should make it even more insolvent. So, again, these are just absurdities. They tell you they're little happy talk that makes no sense. Even as concerns grow about specific institutions, you'd be damn near all of them, because they're all insolvent. She said, smaller community and regional banks have seen a rise in deposit outflows following the failures of SVB. Signature, while big banks seen as too big to fail, are more likely to be bailed out, have been the beneficiaries already, I guess. But again, those big banks go under once their derivatives exposure, because the rates and the dipshit trade affects everything, once trillions of their derivatives implode. This has led to concerns that as deposits flee local banks, their provision of credit will dwindle. Well, banks won't even exist, providing any credit, with negative economic impacts, especially on small businesses. Yellen said it was important for regulators to assess whether the current supervisory and regulatory regimes are adequate for the risks that banks face, and if not, then policymakers must act. This isn't the result of regulators not doing enough. This isn't the result of bad or policy or more laws that are necessary. This is full of dipshits who should not have their jobs. I mean, they had one simple task and they couldn't do that right. And their bank should not exist because if you're that incompetent, you really should not be in business. While she made no specific proposals for tighter regulatory and supervisory standards. What, you're going to tell them that, the simple basic, if there's inflation, that means rates go up. And if rates go up, it means your capital that you have in bonds goes down. It's pretty simple. She said any next steps must take into account the health and competitiveness of our vibrant community and regional banking institutions, which could face an outsized impact from more regulations. More regulations aren't going to change the fact that morons are morons. She acknowledged that more regulation means bigger and costlier burdens on banks in general, which means you, the bank's customers, will pass that cost on to you. But such costs pale in comparison to the tragic costs of financial crises. You mean the actions of dipshits. Shadow banks in the crosshairs. In her speech, Yellen called for tighter regulation of the growing non-bank or shadow bank sector, which includes money market funds, hedge funds, and crypto assets, or shitcoins there. In the traditional banking sector, there are rules and measures in place to reduce the risk of bank runs. Such as making sure you have adequate capital reserves and knowing what U.S. Treasuries do when rates go up. Alongside capital and liquidity requirements for banks, there are also supposedly the most liquid financial instruments on earth having liquidity problems. I wonder why. There are also deposit guarantees provided by the Federal Deposit Insurance or the Bail-in Administration Corporation, which all reduce the likelihood that depositors will rush to withdraw their savings at the first sign of trouble. They should withdraw it because they're insolvent. Yet the financial stability risks posed by money market open-end funds have not been sufficiently addressed, Yellen cautioned. Money market funds in particular are vulnerable to runs and fire sales, Yellen said. Ooh, looks like they're figuring out how these things work. In part due to the so-called first mover advantage that establish an incentive for investors to redeem at their risk of a problem. You don't want to be the bag holder, especially when all this shit collapses. Well, it is collapsing. It's in the middle of collapsing. The first mover advantage in context of money market funds means that the first redeemers can exit the fund at $1 per share, while those who wait may be subjected to a reduced market value and so take a haircut. This creates an incentive for investors to redeem at the first sign of a problem, which can lead to runs and panic sales that pose a risk to financial stability. Again, looks like they just figured out. What is this now? 2 weeks later, 3 weeks later. Give them half a week to figure out where to move their cash, and then 3 weeks later, they only figured out how money market funds work. Only now. During the 2008 financial crisis, expected losses on Lehman Brothers commercial paper led to a run on the $62 billion reserve primary fund, which in turn sparked concerns about commercial paper issued by banks and led to runs on other money market funds. And for those not familiar with the commercial paper market, that is also what should be a very liquid market. These are essentially loans between the huge banks. And when you have problems there, you definitely have problems. The first mover advantage was also at play in March 2020 amid the pandemic shock when a record $255 billion flowed out of bond mutual funds, Yellen noted. This and other structural vulnerabilities regarding money market and open-end funds aren't new. Again, these aren't structural vulnerabilities, these are just how they work. And the Securities and Exchange Commission has, over the past 2 years, sought to address them through new regulatory proposals. Sounds like going to the moon to me. In particular, the SEC's proposals would reduce the first mover advantage and also require new liquidity management tools, mandate that these funds provide investors and the SEC with more comprehensive and timely information. So what they want it to be like demand deposit institutions. Negative spiral of margin calls. Hedge funds, meanwhile, which had nearly $10 trillion in gross assets in 2021, faced leverage risks, Yellen said. Leverage can support economic growth, but excessive leverage is dangerous. Yeah, just take a look at those trillions upon trillions of derivatives worth several times the U.S.'s annual GDP, and they're all going to implode because they're all tied to the dipshit trade, one way or another. It can add fuel to fire sales by triggering a negative spiral of margin calls and rapid asset liquidation. And again, even if it isn't in the first degree, it's in the second, third, whatever, it gets affected by it. These fire sales can transmit stress to other market participants, including large, systematically important banks. Ooh, looks like they're starting to finally figure it out. Look at that. Because again, when those derivatives implode, so do the big banks. The ones that are systemically important. And how does that affect all of that? It affects all of it. Post-crisis banking regulations have helped reduce the potential of spillovers to the banking system, but spillovers from these fire sales to other market participants remain a risk, Yellen said. Yellen said that in an effort to address these risks, the Multi-Regulator Financial Stability Oversight Council's restored hedge fund working group will continue to monitor them and develop policy recommendations. Also on the Treasury Secretary's radar for systemic vulnerabilities that could see the financial crisis are digital assets. Of particular concern are stable coins, which could also be forced into asset fire sales in times of stress. Which again, shit coins. A run on one stable coin, why nobody should go on these little scams to begin with, can lead to panicked runs on other stable coins, causing even broader sell-offs, Yellen said, adding that Congress should pass legislation to establish a comprehensive prudential regulatory framework for stablecoin issuers and for other digital assets. And look again at the morons of these social media instead of paying people money. Because again, don't forget to donate. Because that's why they're only figuring this stuff out now 3 weeks later, by the way. Because you didn't pay your time. These idiots think they'll act like idiots instead of paying the damn money. Mental illness on the internet. Which is, again, why you have a complete failure of your banking system. Don't forget to pay the Bitcoin wallet there. So Yellen said the Biden administration is studying the potential for systemic risk from digital assets. And we are also exploring broader policy issues around the future of money and payments, including the possibility of a central bank digital currency. Definitely needed for your FEMA camps. Meanwhile, global banking regulators have been discussing stepping up scrutiny of how risk from systemically important shadow banks could destabilize lenders. Again, only now do they figure out who runs these money market funds. So, let's see, Shitholer, chair of the Global Basel Committee, which writes bank capital rules. I bet you these people haven't even read Basel 3 or CCAR or whatever that is. But, or whatever they have there, that are applied across the world, said in a speech last week that additional guidance for managing shadow bank risk should be rolled out sometime this year. You mean like not hiring dipshits to do the dipshit trade? That might be where to start with that one. So again, you are in the greatest financial collapse ever. And the only reason why you're in this mess is because you did not donate. God knows that you didn't pay your tithe. Make sure to pay it in the Bitcoin wallet in the description right there. Right now. Because again, you might have figured this out 3 weeks ago had you paid your tithe.